Keep your money liquid and safe, not trapped in your real estate. In this episode, I'm going to address the question, why pay only minimum down when buying real estate, maybe even your house? You're going to learn why I've never paid a down payment out of my pocket for any piece of real estate that I've ever purchased. So my name's Doug Andrew, and I've been a financial strategist, a retirement planning specialist now for more than 48 years. I've been very blessed in my life to have authored 11 books. Right now, I'm working on my 12th. And we've been very grateful for the receptivity. Most of them have been bestsellers. One, a New York Times Wall Street Journal #1 bestseller in 2007. And in these books, I usually have a section about how to own and manage real estate. Now, some people, the only piece of real estate they own throughout their lifetime might be their house. This applies to those of you who all you care about is maybe owning your house. You don't want to be a landlord and fix toilets and evict tenants and take out trash from renters. But other people, they own non-owner occupied rental income real estate and so forth. This applies across the board, even if it's commercial real estate. So many times I have found that people sometimes accumulate money and they will put some of their money in the stock market, which sometimes I compare that in the story of the three pigs to a house of straw, because the big bad wolf, those are recessions and stock market crashes and so forth. It blows down the stock market. And so money in that house of straw, the stock market, is subject to the economic storms. That would be higher risk. Now, money in real estate is usually more moderate risk, but what I tell people is, I don't keep my money all tied up in my real estate. I benefit. I own real estate. I'm not a huge real estate investor by many standards, but compared to most Americans, I probably own more real estate than most do. But I do not accumulate all my money in equity in the real estate. I keep it separate from the get-go. Okay, so that comes back to this question, because where do I want to put my money? I want to put it safely tucked in a house of bricks, because real estate is like the house of sticks. It's moderate risk, but the big bad wolf, recessions cause real estate sometimes to go down in value, and we see those market corrections all the time. Maybe not as volatile as the stock market. That's why it's the house of sticks instead of straw. But I want my money in the house of bricks, and I choose to put mine into max-funded insurance contracts, rock solid, safe in AA, AAA institutions where I'm able to earn average rates of return between 7 to 10%, sometimes much higher than that, but averaging that tax-free, and where my money is always liquid, safe, and earning predictable rates of return, because tax-free returns of 10 would be like earning 15% or higher tax-deferred rates of return in something like an IRA or 401k. Now, let's talk about these key elements of a prudent investment: liquidity, safety, and predictable rates of return. Because whenever you set aside money, you want to make sure you can access money when you need it in the event of an emergency. And I've discovered that money tied up in equity and real estate does not pass the liquidity test. When you need it the worst, it's the hardest to get. If you get laid off or you get hurt or something happens, and you've been sending all this extra money, principal payments against your mortgage, or you put a huge down payment, the only way you can get that back is to borrow it back on the bank's terms and prove there's a need why you should have it. In other words, I have discovered it's a lot better to have and not need than need and not have. It's a lot better to have access to your money and not need it than to need it when it's trapped in your real estate and not be able to get it, okay? And I've learned that lesson the hard way. You can read the stories in my books. Also, safety of principal. I've learned that many times when the real estate market goes down, I've seen pieces of property. I had a house in 1981, 82, that dropped in value from $300,000 down to $150,000. I had a home in 2008 drop in value from 1.5 million down to 1.1 million in less than 1 year. I lost 400 grand. I didn't lose a dime though, because my money was not tied up in the house. I didn't have a huge down payment. So whenever I go to acquire property, I satisfy down payments, but not with my money. Okay. I do not tie up my money unnecessarily. I will always pay the minimum or no amount down, especially out of my pocket. I keep my money separate in a house of bricks, liquid and safe, earning predictable rates of return so that when my real estate goes down in value, I don't lose because my money is not in the real estate. I own it. I get to benefit when it appreciates. But when it goes down in value, I don't lose because my money is not tied up in the equity in the property. Is this making sense? Now, I know I can earn a predictable rate of return over in the house of bricks. My favorite vehicle is called the Laser Fund. And for over 40 years, I've been averaging 7 to 10% tax-free, but I've been averaging 9.62. Now let's just round that down to 9%. It's tax-free. Every $1 million that I could put into paying cash for a piece of real estate or a house, I keep it separate and it's earning, let's say, 9% a year. That's 90,000 tax-free. Now, if I borrow $1 million on a mortgage at 4.5%, let's say, tax deductible in a 33% bracket, I pay $45,000 a year in mortgage interest. I deduct that off my tax return. I get a lower tax bill or a bigger tax refund. I'm really only paying $30,000 out of my pocket for a $45,000 mortgage interest outlay. Does that make sense? Because I'm getting a third of that back in tax savings. This is real money. So when you borrow money tax deductible at 4.5%, it only costs you 3 in a 33% bracket. Okay, let's do the math. On $1 million, I am borrowing $1 million. It costs me $30,000 a year. I'm happy to pay that because that $1 million, by not being in the real estate, because the real estate's going to go up or down regardless of how much equity's in there, it has nothing to do with it. That $1 million's earning 9. That's 90,000. How much more is 90,000 than 30,000? It's 3 times 300% more. Hello? That's just becoming your own banker. And so I teach these concepts in my various books, and this is why I've rarely paid anything out of my pocket in a down payment because I keep the money separate, earning rates of return of double, triple, even quadruple, some years 5 times. I've borrowed money at 3% tax deductible, a net cost of 2, and I've earned 10% many years. How much more is 10 than 2? On $1 million, that's $100,000 versus 20,000. Would you pay 20,000 for a widget machine that made you an extra 100,000? Yeah, that's a 500% return on equipment cost. So I'm going to show you that if you want to get out of debt, you can actually get out of debt 2.5 years faster by not sending extra principal payments to the mortgage company. But before I do so, please subscribe to this channel. If this is intriguing you, I have over 500 educational videos like this one on this 3-dimensional wealth channel. And click like, post a comment, but subscribe. And when you subscribe to the channel, be sure and click that little bell and you'll be notified every time I post a new in-depth answer to a financial question, which I do almost on a daily basis. It's free. And I'll tell you what, if you stay with me to the end of this episode, I'll show you how you can claim your free copy of my most recent best-selling book. It's called The Laser Fund. It's 300 pages, and I want to buy this book as a gift for you. You contribute a nominal amount towards the shipping and handling. I'll show you how to do that. So let's go back to this concept. Now, if you understand what I've been saying, I don't tie up any money unnecessarily in some big down payment. I pay the least amount down or nothing down out of my pocket, and I keep it separate. So a lot of people will send extra principal payments to the mortgage company, and it's like saying, here, Mr. Banker, here's an extra $100 or $500 this month. Apply this toward the principal of my mortgage. Don't pay me any interest on that. If I need the money back, I'll borrow it back on your terms and prove there's a need why I should have it. Now, it sounds silly when I say it that way, but that's what you're saying every time you send extra money against your mortgage. Why are you doing that? Because you think you're going to get the mortgage paid off sooner and it's going to save you a grundle of interest. What if I told you you're costing yourself? Now, based on what I've told you, if by keeping your money over here, I'm talking about in a laser fund, let's say earning like I have earned an average of 9%. Some years less, some years much greater. but 9% tax-free, and your mortgage is at 4.5%, okay, half that, but it's tax deductible, so it's a net cost of 3%, you're making 300% more than the cost of the mortgage. Hello? That's why banks are so willing to pay you 1% because they're going to earn 4 or 5% by taking your money and loaning it back out again. So if you were to set aside what you would send against your mortgage into a laser fund, it would compound tax-free. There would be enough money to pay off a 30-year mortgage in about 12 and a half years with the same money that you're going to shell out to get the mortgage paid off, let's say in 15 years by sending extra principal payments or doing a 15-year mortgage. Why do that? Because if you do that and you need the money back, you have to borrow it back. If it's over in the laser fund, you can access it anytime for an emergency. But because you're earning compound interest tax-free in the laser fund and you're paying simple interest tax deductible at a lower rate in the mortgage, the money will grow to enough to pay off the entire mortgage faster, about 2.5 years faster than any form of sending extra principal payments against your mortgage. Don't believe it? You need to see the numbers and the charts because math doesn't lie. So folks, if this is intriguing you need to learn and study because people do not realize not understanding these concepts, how money works, often costs them several $100,000 one way or another. So this is how you can learn more. Go to laserfund.com, laserfund.com. Click on the link below. And I want to fire out a free copy of this book. This retails for $20 on Amazon. I'll pay for the book. You simply contribute a nominal amount towards the shipping and handling, and this is what you can do. You will get a copy of this 300-page book, and you'll also have options if you like to listen and learn or watch and learn. There's even an 18-hour masterclass if you want to do a deep dive. But you can start here, and this will teach you how to diversify and create the foundation for tax-free accumulation for retirement or whatever goal. If you're managing real estate, many real estate managers use the laser fund as their working capital account and to get out of debt quicker, faster, smarter. Now, it's actually 2 books in one. This side is for those of you who like to learn with numbers and charts and graphs. It's 200 pages. But if you learn more by stories and examples, you flip it over and read this one, which is 100 pages, 12 chapters with 62 actual client stories of how the laser fund could be used for all kinds of financial goals. So folks, take ownership of your brighter future. Claim your free copy. Subscribe to this channel, and I will see you in your brighter future.